Welcome to this deep dive. We've got quite the stack of sources today. It's 5 days of daily crypto updates from our newsletter, Nifty Noon. We're covering November 3rd right through to the 7th, 2025.
And what a week it was. Just completely chaotic, historically so, I'd say.
Absolutely. I mean, if you were just looking at the headlines, the short-term stuff, it was dominated by disaster.
Oh,
right?
yeah. Two massive things jumping out. That huge Balancer security breach, over $110 million, just gone.
Ouch.
And then the market crash that followed, wiping out, what was it, $1.14 billion in leveraged long positions. Just brutal.
But it's only half the story, isn't it? Because underneath all that chaos, there was this thread of, intense conviction.
Exactly. On the other side, you had Changpeng Zhao, CZ, basically moving a whole token market, ASTER, up 30% with just a $2 million personal buy.
Incredible influence.
And then the big one for Builders Monad, the big Layer 1 blockchain finally announced its mainnet launch date. Huge anticipation there.
So our mission today is basically to untangle this mess, right? Walk through the week chronologically, see how this clash between market chaos and deep-seated conviction played out.
Yep. It's a story of hacks and leverage getting washed out, but also strategic bets being placed.
Okay, let's unpack this then. Starting with November 3rd and the, frankly, surprising power of one person's wallet.
Right. So November 3rd kicked off with CZ. The Binance founder, he announced quite publicly that he'd bought a pretty hefty amount of ASTER.
Okay, and ASTER is the token for that derivatives platform on BNB chain.
That's the one. And the key wasn't just the amount, though it was significant, about 2.09 million ASTER, roughly $2 million at the time.
So not pocket change.
Definitely not. But the way he framed it was powerful. He compared it to his early investment in BNB itself.
Ah, okay. So he's basically signaling, I think this has the same potential, long-term belief.
Precisely. And the market just reacted instantly. The ASTER token jumped nearly 30%, hitting $1.17 almost overnight.
Wow. Just based on his buy and that comment?
Yeah. It shows his immense influence. Plus, it didn't hurt that the ASTER team had just announced new tokenomics. They were bringing in a buyback and burn mechanism.
Right, making the token potentially more deflationary. So CZ's timing was, let's say, very effective.
Very effective. A clear validation for that project and, by extension, the BNB ecosystem he's associated with. But, it's important context. While CZ was making waves in the BNB world, institutional money was still flowing heavily into other areas. Same day, the Bitwise Solana ETF, the SOL, reported $417 million in weekly inflows.
$417 million into a Solana ETF.
Yep. Highest inflows across all U.S. crypto exchange-traded products that week. So while CZ's boosting BNB, the big money players were clearly still very interested, maybe even doubling down on Solana.
Okay, so parallel tracks of conviction, really. Interesting. But that positive momentum... Well, it hit a brick wall on November 4th, didn't it?
Oh, yeah. November 4th was grim. The news broke about Balancer. Their V2 pools got hit by a massive security exploit.
Massive is right. Over $110 million drained. Some estimates even push it towards, $128 million.
Yeah, the numbers were huge. A catastrophe for the protocol and its users.
And do we know why those specific pools were targeted? What made them vulnerable?
It seems the attackers went after the Balancer V2 composable stable pools. These held a lot of liquid staking tokens, LSTs.
Things like wrapped ETH, staked ETH, derivatives, stuff like that.
Exactly. WETH, OCETH, ProCETH. These are really valuable, widely used assets in DeFi, making them a prime target. And the attack wasn't just on one chain. It hit their pools on Polygon, Base, multiple fronts.
And this isn't the first time Balancer's had major security issues, is it? I feel like we've been here before.
Fortunately, yeah. This was at least the third major incident. It's a tough reminder that even established DeFi protocols, they carry significant risks. One vulnerability can just ripple outwards.
And ripple it did. What was the immediate fallout beyond the lost funds?
Well, Balancer confirmed they were investigating, offered a 20% bounty for the fund's return, a white hat offer, but the damage spread.
Naturally.
The BAL token, Balancer's native token, dropped over 4%. But maybe more critically, it triggered problems elsewhere.
Oh, like where?
The validators on the Berachain network, they actually had to halt the entire chain.
Halt the whole network. Why?
Because related exploits started popping up on Berachain's own native DEX called BEX. They had to stop everything, coordinate, and perform a hard fork to fix the issue stemming from the Balancer problem.
Wow. So one exploit on Balancer forced a completely different blockchain to do a hard fork. That really underscores the interconnectedness and the systemic risk.
Absolutely. That level of contagion, it's scary. And that fear, that systemic risk, that's pretty much what set the stage for November 5th.
Yeah, the November 5th update was just pure market panic, wasn't it? Yeah. Following the Balancer news, plus maybe some general anxiety, Bitcoin just took a nosedive.
It fell hard. Dropped from around $112,000, crashed right through the $100 K support, and dipped below $99,000.
And that triggered the cascade, right? The long squeeze.
Exactly. That sudden price drop just wiped out leveraged positions. We're talking over $1.27 billion in futures contracts liquidated, gone.
$1.27 billion. That's enormous.
It is. And get this. Almost 90% of those liquidations, about $1.14 billion, were long positions, people betting the price would go up.
So basically a massive wave of forced selling as margin calls hit. That $1.14 billion, that's almost 10 times the size of the Balancer hack itself, just pure financial leverage getting vaporized.
Precisely. Hyperliquid, the derivatives platform, saw the most forced closures, about $374 million just on their platform. And the mood, it just collapsed.
Yeah, the crypto fear and greed index, where did that end up?
Plummeted to 20, deep into extreme fear territory, just sheer panic across the board.
What fueled this beyond the Balancer news? Was it just that or other factors?
It was a confluence, really. You had the recent ETF outflows putting pressure on price. You had data showing long-term holders, often seen as the smart money, had actually sold off 405,000 Bitcoin in the previous 30 days.
Selling into the run-up, basically.
Right. Taking profits. And then you layer on the macro anxiety. We even had that quote from U.S. President Trump around that time. I only care about one thing. Will we be number one in crypto? Which, sounds bullish maybe, but also highlights the political uncertainty still swirling around everything.
So fear, forced selling, smart money taking chips off the table, political noise, a perfect storm for a washout.
Pretty much. Analysts were quick to point out, though, that these kinds of squeezes, while incredibly painful, do tend to clear out excessive leverage. They can, sometimes, set the stage for a healthier move upwards later.
A reset, maybe, but not without real casualties.
Definitely not. We saw reports like Sequins, a company selling almost a third of its Bitcoin treasury just to pay down debt, and the Stream Fund had to disclose a $93 million loss. Even more conservative players got hit hard.
A brutal day. But, in crypto, the narrative shifts fast. After all that fear and liquidation, November 6th brought us back to innovation.
Exactly. The focus snapped right back to building. The big news on the 6th was all about Monad.
Yes, the much-hyped new Layer 1 blockchain. What was the announcement?
They officially set the date, mainnet launch, and the MON token going live on November 24th.
Okay, so a firm date. And remind us, what's the big promise with Monad? What's their pitch against the likes of Ethereum and Solana?
Speed and compatibility. They're targeting 10,000 transactions per second, which is massive, with low fees.
10,000 TPS, that's ambitious.
Very. But the crucial part, the real hook for developers, is full EVM compatibility.
Right, the Ethereum virtual machine, meaning projects built for Ethereum can just move over easily.
Pretty much, yeah. No need to rewrite everything from scratch. That compatibility is absolutely huge for attracting developers in existing applications. It drastically lowers the friction.
And they got the war chest to back it up, right? Didn't they raise a ton of money?
Oh, yeah. Over $240 million from top VCs like Paradigm. So they have the resources. And the market is clearly excited. Even before launch, the MLN token was doing serious volume and pre-market trading on Hyperliquid, over $14 million in just 24 hours.
Wow, that's significant pre-launch buzz. What about the community aspect, the airdrop?
That concluded too. They allocated tokens to around 225,000 users. They targeted active DeFi users, NFT holders, trying to get the token into the hands of people already participating in the ecosystem.
So a lot of focus on building this new, potentially faster, more scalable infrastructure, despite the market carnage just days before.
Exactly. And it wasn't just Monad showing that infrastructure focus. On the same day, we saw Ripple announce a massive $500 million strategic investment.
Ripple? Who led that round?
Big names from traditional Finance Fortress and Citadel Securities were leading it.
Interesting. Citadel getting deeper into crypto infrastructure investment.
Yep. And ZK Sync, another Layer 2 solution, saw its token jump 24% after they announced new plans for token utility. So the theme on the 6th was clear. Despite the futures market getting wrecked, serious long-term capital was flowing into building and improving the underlying tech.
A real contrast. Okay, that brings us to the last day in our stack, November 7th. And this one brought Well, a different kind of drama, right? Controversy.
Yeah, November 7th was dominated by the fallout from the mega ETH ICO allocation results. This was a hugely anticipated project, massively oversubscribed.
How oversubscribed are we talking?
They were trying to raise $50 million. They had $1.4 billion committed, so like 28 times oversubscribed. Insane demand.
Okay, so how on earth you decide who gets an allocation when you have that much interest? What was their method?
They used the system they called the conviction round. It was data-driven, looking at users' on-chain history and activity. But, and this is the key part, the biggest factor by far was whether participants were willing to lock up their mega tokens for 1 full year after receiving them.
Ah, so they weren't just looking for active users. They were specifically filtering for people willing to commit long-term capital, hocho dealers, basically.
Essentially, yes, they prioritized long-term commitment or conviction measured by that lockup willingness.
And how did that play out? Who actually got in?
Well, it caused a huge stir. Participants who did agree to lock their tokens, assuming they passed the other filters, got significantly larger allocations. The average was around $75,000 worth.
Okay, pretty substantial. And for those who didn't want to lock for a year?
That's where the controversy exploded. Only about 10.1% of the unlocked participants actually received an allocation, even if they had a stellar on-chain history.
Ouch. So you could be a super active, valuable community member, but if you didn't click that lock for 1 year box, you probably got nothing.
Largely, yes. And the criticism was fierce. People called it misleading. They argued that genuinely valuable users, people with strong track records in DeFi or NFTs, were filtered out simply because they preferred liquidity over a 1-year lock. It felt like the process prioritized sticky capital over, say, community engagement or past contributions.
Yeah, I can see why that would rub people the wrong way. It's a really tricky balance for projects, isn't it? How to reward conviction without alienating active users.
A very tough needle to thread.
Were there any other notable things on the 7th, outside the mega ETH trauma?
A couple of smaller but still interesting signals. We saw a stablecoin, DUSD, lose its peg pretty badly, dropping down to about $0.10.
Oh, wow. Another reminder that not all stablecoins are, well, stable.
Exactly. Still a point of structural risk in the system. But on a more positive integration note, Polymarket, the crypto prediction market, announced its data, like odds and market forecasts, would start being integrated directly into Google Finance.
Oh, interesting. So crypto native prediction data showing up alongside traditional stock prices and financial news on Google.
Yep. Another small step of crypto bleeding into mainstream financial tools and search results, making that kind of information more visible and accessible.
Okay, so looking back at this whole week, this November 3rd to 7th stretch,
Yeah.
what's the big picture? What does it all mean?
Well, it's that dichotomy we talked about up front, isn't it? The sheer volatility, the fragility exposed by the Balancer hack, the way over $1 billion in leverage could just vanish in the long squeeze. That shows the market is still highly reactive, maybe even immature in some ways. Technical failures and rapid shifts in sentiment can still cause massive damage.
Yeah, the short-term picture was definitely one of risk and fear dominating.
But then you contrast that with the underlying conviction plays. CZ's $2 million bet, Monad pushing forward with its ambitious L1 launch backed by $240 million, Ripple pulling in $500 million from TradFi giants, even Mega ETH prioritizing that 1-year lockup.
Right. So the final takeaway for you, the listener, seems to be this. Don't get too caught up in the day-to-day swings driven by exploits or fear and greed cycles. Yes, they impact price massively in the short term.
But the bigger, longer-term story, where the serious capital is flowing, seems to be dictated by strategic conviction. Belief in specific projects, belief in the need for better infrastructure, and sometimes controversial mechanisms to ensure capital sticks around.
Which leads us perfectly into a final provocative thought for you to chew on.
Given that huge controversy around the Mega ETH allocation, where they explicitly favored locking tokens for a year, how are future big crypto projects, ICOs, token launches going to navigate this? How do you balance generating that crucial short-term buzz and retail excitement needed for launch momentum with the desire to secure those high-conviction, long-term holders who won't just dump the token at the first opportunity? Where's the sweet spot between rewarding participation and rewarding commitment?
A fundamental tension indeed, something the market is clearly still figuring out.
Yeah.
Okay, that wraps up our deep dive into what was a truly wild week in crypto. Thanks for joining us.
Yeah, thanks for listening.
And hey, if you want this kind of analysis and the key daily updates delivered straight to you, make sure you follow Nifty Noon on X and Substack. We'll catch you next time.